Well, the trader's paradise does it again. You've probably seen the video on Carmax where we made 636% shorting it via put options. Today, you've guessed it right, we're going to talk about Carmax again. However, we're not going back into the past, we'll be looking at it with a fresh pair of eyes as we head into earnings. Now, in the previous video, we did look at some of the KPIs at the industry and company level, and today we're going to be reviewing it with additional information just to understand how things have been evolving and to figure out if Carmax is going to be the gift that keeps on giving. For those who've been watching and engaging, thanks a lot for your support. It's been a lot of fun. For those who are new to the channel, welcome. Stick around till the end and you'll find out for yourself if this is the channel to follow for understanding the financial markets, trade idea generation, and eventually finding opportunities that lead to massive returns on investment. So fasten your seatbelts, buckle up, let's get ready for our next idea. Before that, please read the disclaimer, and for the love of God, no copy trading please. Carmax is the largest retailer of used car vehicles in the US. It trades at around $76.54 at the time of filming, giving it a market cap of $12.1 billion. It has a forward PE of 24.5 times and a short interest of 12.2%, which is around 8.5 days to cover. Despite projecting a low annual revenue growth for Carmax, analysts are still expecting a relatively high rate of growth for earnings per share. This explains the high forward PE of Carmax at the moment. In our thesis, we explain why we believe this is far-fetched. Wall Street analysts are probably wrong and likely to revise these estimates downwards, dragging the share price down as well. There are currently 20 analysts on Wall Street following the stock. 3 have a strong buy rating, 7 a buy rating, 6 a hold rating, and only 4 with a strong sell rating. The price targets from analysts range from $44 to $135, with an average of $78.28. So, if we are right that the company's fundamentals might be weakening fast and that it might be missing on future estimates from analysts, that in itself could create a lot more downside for the share price. Analysts will have to review their price targets downwards and maybe even downgrade the stock, turning some of the buy ratings into sell ratings. You would be familiar with this slide about the business model for Carmax. It basically sells used vehicles and generates a gross profit, and at the same time it has an auto finance segment which generates an interest margin through issuing loans. On the expenses side, it has overhead and occupancy costs, and it has to also keep aside loan loss provisions for bad debts. Last quarter, Carmax reported that revenue has been down quite significantly from a year ago. This is definitely not a positive for the business. Management has been doing pretty well in terms of cutting costs over the past few quarters, but we believe there's only so much they would be able to cut. We have seen an improvement in terms of SG&A, which is basically cost, as a percentage of gross profit from 84.1 versus 90.4 from last year. Now, in all fairness, this is a positive for the business, but it's still relatively high in comparison to its competitors. One of the most important factors to discuss here is loan loss provisions. So in the previous video, remember we said that this is kept for bad debt. So basically, people who have been given out auto loans and are unable to repay their loans now. In last quarter, Carmax reported that this number increased from 75.5 million from last year to 89.8 million. So this indicates to us that we're having a problem with delinquency, and therefore if we want to understand the future pathway of the stock price, we'll need to understand what's going to happen to delinquencies over the next few quarters. So the company reported net earnings to be down 5.8% from last year. A large part of that came down to gross profits per unit having reduced over time, and also loan loss provisions having increased quite significantly. We'll look at the impact of loan loss provisions on net earnings in a few slides later. Let's now look at what's happening across the industry, and then we'll come back and put things into perspective to explain how these factors are likely to impact Carmax. The wholesale car prices, which we believe is a close leading indicator for used car prices, keep falling. Now it's been falling throughout the year, But most worryingly, what we're seeing now is the pace of decline is accelerating. Not surprisingly, retail used car prices have been falling too. Now you must be wondering, why is this relevant for Carmax? Well, we know that Carmax acquires used vehicles and then resells them for a profit. However, if it's acquiring inventory at a higher price and then is only able to sell into a lower market, that is likely to be putting a lot of pressure on its gross margins. Looking at the inventory level across the industry, we believe that used car dealerships might be having a problem in that inventory levels are too high. The graph here is basically saying that we are taking many more days now to be able to sell inventory. This could mean only one thing: demand is not there for the level of inventory that these companies are carrying. Therefore, we are likely to see further declines in used car prices, which will eventually put a lot more pressure on the gross margins of used car dealerships like Carmax. As we look into delinquencies at an industry level purely for auto loans, we're seeing some worrying trends. So remember, in our previous video, we were debating as to whether this increase in delinquencies is basically just a normalization in delinquency rates, or whether we're seeing something more sinister. I would argue it's the latter. For a more in-depth understanding of the situation around delinquencies, we look at Ali, which is one of the largest auto lenders in the US. On a quarterly basis, they report delinquencies on their auto portfolio, as well as the net charge-off rates for the same portfolio. What we can clearly see is an uptrend, and it's also worrying that now in Q3 of 2023, they reported that even the net charge-off rates have increased drastically, so 1.85, much higher than the last 4 quarters. For those wondering, the net charge-off rates are an indication of what the bank estimates to be bad debt, so money that will not be recovered. On this topic of delinquencies, Carmax actually report quite comprehensive data on its portfolio. This red rectangle indicates the cohort from 2021, which is basically during the COVID era after stimulus was provided by the government. The green rectangle indicates the cohort before the COVID era. So we'll use this as a control and reference to understand the numbers that we're seeing from the 2021 cohort. We can see that the delinquency ratios are significantly higher in the 2021 cohorts in comparison to the 2019 cohort. This leads us to believe that there is a lot more pain waiting to happen, that Carmax will probably need to increase loan loss provisions much more, and therefore the net earnings are likely to suffer over the next few quarters. So remember, the whole premise of the thesis was that we believe that analyst expectations of future earnings were too high, and that the stock price is likely to come down as analysts review their numbers, causing the stock to get downgraded. Moving on, we're going to look at Carmart, which is a competitor for Carmax that operates in a similar industry. It reported earnings on the 5th of December, so a couple of weeks ago, and not surprisingly, it also reported an increase in credit losses or loan loss provisions, which eventually impacted quite negatively on its net earnings. So this ties in very well with what we're seeing with delinquencies at an industry level, with the reports from Fitch, the reports from Ali, the reports from Carmax themselves, and now, most recently, from Carmart. Coming back to Carmax, I think this is probably the most important slide in the presentation. Why do we keep talking about delinquencies? How does it matter to Carmax? Let me walk you through this. Maybe the penny will eventually drop. So, in Q2 2023, the net earnings for Carmax was 118.6 million. So this is net profit, right? And this is generated from multiple segments that Carmax operates. Out of these segments, the Carmax Auto Finance income or profit is 135 million. So on its own, it's much higher than the net earnings for the company. So keep that in mind, because now we've realized that the net earnings for Carmax is very sensitive to Carmax Auto Finance income. So the next step would be to understand what makes up Carmax Auto Finance income. I'm going to spend a little bit more time explaining the mechanism of how Carmax Auto Finance generates its income. This will be critical for you to have the light bulb moment, so the penny drops and for you to truly understand the premise of this trade. As Carmax issues auto loans, it's able to collect interest and fee income on these outstanding loans. However, it also has to pay interest to whoever is funding the capital for these loans. So, on a net basis, it's able to make a total interest margin of 264.9 in Q2 of 2023. However, it also has to set aside loan loss provisions for all these bad debts that we have seen in the past. As we can see, this number keeps increasing every quarter, and this is related to the worrying trend in increasing delinquency ratios that we've been seeing in the past few slides. We can therefore conclude that Carmax Auto Finance income is very sensitive to the provision for loan losses, which is why we've been speaking quite lengthily about delinquencies and loan losses across the industry. As loan losses increase, it's obvious that the Carmax Auto Finance income will decrease, and if that happens over the next few quarters, we can definitely conclude that net earnings will suffer as a result. Therefore, we go back to our original premise. We had indicated that analyst expectations of future earnings are too high and that they would have to review them downwards. And now we've been able to walk through and understand how that whole mechanism might happen. And also when we look at the industry level, we can see that fundamentally the stage is already set up. So in terms of catalyst, we see that used car prices will keep falling and this will keep eroding gross margins. The high used car inventory levels are likely to trigger further declines through discounting mechanism. This is going to compound the whole problem with used car prices falling. On top of that, we know that high interest rates have been impacting customers from an affordability perspective, but also in terms of availability of credit. Consumer confidence has definitely improved, but we can see that demand for cars is still low. I think what we are seeing is customers know that used car prices are falling and therefore they are delaying their purchases. So far we've seen the job market strength waning. Should we have further weakening in the job market, we will definitely see delinquency rates rising. With that, we are likely to see loan loss provisions increasing, which is a big negative for earnings. We're also seeing the phenomenon of negative equity for car owners who have financed their purchase with debt. This could increase their propensity to default on their auto loans, further worsening the situation with delinquencies and loan loss provisions. Side by side, the increasing car repossessions from delinquent loans deteriorates the situation by increasing the supply of used cars in the market, therefore putting a lot more pressure on used car prices in the future. So, how do we play this? Well, the current price at the time of filming is 76.54. We initially had a target price of 50, which is a 35% drop from here. However, after last week's Fed meeting, the stock has rallied quite significantly, and we now believe that 60 might be a more realistic target. At this point in time, given all the information that we've got, I believe there's significant opportunity in playing this situation by buying the 19 January 2024 puts with a strike of 67.5 at around $1.1 per contract. If the price goes to 60 by January 19, 2024, these puts should be worth $7.5. This gives us a break-even price of 66.4, which implies a 14% move needed from here. If the price gets to 60, that gives us a potential profit of around 682%. This is a massive return on investment. As always, we have to consider the risks to the thesis outlined. One of the problems here is that the market already knows that the car prices have been falling and are probably going to keep falling into the future. So, it's probably already consensus and already built into the stock. The market can also decide to look ahead of the next few quarters as the stock can absorb bad news. However, keep in mind that our thesis is not necessarily centered purely on car prices coming down. it's a different story. It's more to do with delinquencies. But nonetheless, we have to take into consideration that the market already knows about the car prices falling and that it's already consensus. The other significant risk is more on the macro side. As we've seen last week, the Fed has hinted that we might get interest rate cuts in 2024, and the market liked that a lot. So the market has started pricing in a recovery for companies that are involved in interest rate sensitive areas, which Carmax is one of them. We also have to take into consideration that the management at Carmax has been doing everything they can to control cost, and they might still have levers to be able to cut costs and offset the impact of falling gross profits on earnings. However, again, remember, the premise on our thesis is no longer on gross profits falling. It's more to do with loan loss provisions impacting the earnings or the P&L of the company. And lastly, as we discussed, the job market can stay strong, and that could keep delinquencies contained. This is a major risk to the thesis. The market will then see this as a normalization in delinquency rates, more in line with the pre-COVID period era, rather than a cyclical downturn happening in the industry and for Carmax. For those who've made it so far, well done. I will leave you to ponder on this slide. This is likely to set the stage for future trades on the auto sector that will happen in 2024, mainly in the new car segment. I'm not going to say much here. We've already spoken about negative equity, increasing inventory levels, and now what we see in this slide is an increase in manufacturers' incentives to improve inventory turnover. With this, I wish you happy trading. Watch out for Carmax earnings tomorrow. I think we're likely to have very interesting information from the company. From my perspective, I think we're going to have fireworks. So keep watching, keep engaging, keep asking your questions, and please subscribe, like, and comment on the video.